here you are at 25. Are you in the six-figure earning range?
I'm fortunate to be there. Yes.
Yes. And just after 2 years of being full-time. Do you know how rare that is for people coming out of college and 2 years into a job making six figures? That is rare. That is in less than 10% of the people. And yet you achieved it.
Hey, the information's out there. I know you made a podcast very recently about how to make 100K first year in the business. Those are steps you got to follow. So I niched down. I used a system that I knew it could work, and I duplicated it.
Well, welcome back, everybody, to another episode of the Life Insurance Academy podcast. We've got another special treat from you. This time from Mile High City, all the way in Colorado, Denver, to be specific. One of the most energetic and greatest dudes I've ever met. Super positive. This guy always has a smile on his face, always looking to help somebody and always looking to learn. And I've gotten to know him over the past year and a half, 2 years. And every time I'm with him, I'm like, I've got to help profile him, got to help him tell his story to the world because more people need to know Mr. Aidan Stout. Welcome, man, to the Life Insurance Academy podcast. This is your first episode with us. Welcome to the show.
Super grateful to be here, Roger. Thanks for having me.
Dude, every time we get together, you're like always smiling, always energetic, always upbeat, always wanting to help. What made you like that? Why is Aidan Stout this guy that I'm always attracted to when I'm in a crowd and I see your face, like I want to come over and talk to you? Where does that come from, man?
I got to give you some of that credit because some of it is environmental, like the conferences that we've been together at and the events we've been together at, other people are bringing the energy too. So it's much easier for me to elevate it and match that.
Sure.
So it's honestly a big part is the people around me.
So clearly you're how old are you, Aidan? How old are you?
26.
26 years old. How long have you been in the life insurance business?
3 years this month.
3 years this month. Are you having a good run?
Yes. And, I'm seeing a big difference in that third year than the first two. And so, I'm definitely seeing where this can go, getting a lot of positive momentum. And it's 2 years full time. So it's, I'm really excited to be putting all my time into my business instead of first year was part-time.
Yeah. Most people 25 years old are still, coming out of school or coming out of a master's degree of some sort, now trying to figure out where they're entering. You've already been in this business for you got it started when you were 22. What attracted you to the business? Number one. And number two, a lot of other people your age fail out. They don't make it. They they're in 6-8 months, they're gone again. Number one, what attracted you to the business? And number two, what do you think held you in and why were you successful to get to year 3 now and seeing some major six-figure success?
Yeah, sure. So what opened the door for me to see the opportunity was my dad was a Medicare broker. He started his business in 2011 when he was in his 60s and he loved it. And he was, in charge of his own schedule. He was helping people all day. I'd sat in with him and it was just, this seems great. But then when I learned more about the industry, I saw what, the different avenues it can go. Medicare is one avenue. You can go several different ways. Life insurance is a great place to be. But the fact that what I did yesterday can stack and the fact that I'm helping folks face to face as a broker, I really thought that was a great avenue for me to learn business and to take some ownership on building a business would be really good for me in my 20s, I thought.
Yeah. And so you've been in the business now for 3 years. What's been your primary focus of business, I guess, in that time? I know it's now expanding out, but you kind of had a specialty focus that is kind of unique. And I don't think we've talked about it a lot on this podcast, but I think these guys need to know what it's about because I know you're passionate about it.
Absolutely. Yeah. So first year, part-time Medicare broker, working at a restaurant, coaching soccer too.
Yeah.
Took the leap of faith. Sorry to return to your other question. Take a good thing for new agents is take a leap of faith, when you're at that point, really dive in. That's going to help you most. Those that take that usually will stick. Those that haven't, I've seen drop off. So that's a big element too. But second year, I really got passionate about cash value life insurance with a program called MPI. And I know that'll be new to a lot of your listeners. Some will have seen it, Curtis Ray on TikTok and his marketing. So would love to get more insight on how that works and what that side of the business looks like.
What's MPI? You dropped a term on us there that
Sure.
like I had to ask you what MPI was. What's MPI?
Yeah, so that means maximum premium indexing, which is a mouthful, right? But
Yeah.
essentially, you're fully funding a cash value plan. So the most money is going towards index growth rather than the expenses involved.
I know you just gave like such a simple explanation of that, and people are listening to this thinking, I thought life insurance was supposed to pay when you die, and you just said the word indexing and premium and growth, and you're using terms that I'm not familiar with when it comes to life insurance.
Sure.
So what I'd like to do is just peel back some of the layers on that, and why this is a cool concept, how it works, and maybe so that we can disclose and uncover this opportunity for people out there that may want to get more information about it.
Absolutely. Yeah. First and foremost, I'm not a financial advisor. I don't pretend to be one. That's not my role.
Yeah.
But we know that life insurance is malleable and you can do a lot of things with it. IULs came out in 97. Roth IRA came out in 98. Those are the two tax-free retirement vehicles that are widely known. Municipal bonds, less mainstream. But those are two great tax-free retirement vehicles. And it's not for everybody, but when the circumstances are correct, be a great way to build some tax-free income and to let your money work with a proven index over time and really harness compound interest because you have a downside protecting you.
So people getting into the business, life insurance is not just for when you die.
No.
Why not?
Yeah. So,
I'm breaking it down and asking you questions like the person who's just listening to this for the first time going, I have no idea what they're talking about, Roger. And we get an email saying, I didn't know anything about this and tell me more. So we're breaking it down for those people.
Sure.
What do you mean life insurance is not only for when you die?
For sure. And in most carriers' eyes, it may just be a life insurance policy, but we know what living benefits are, right? Those are in-term policies.
Some people know what living benefits are. Some of our listeners do not.
Okay. Yeah. So, living benefit is something you can take advantage of while you're still alive. So while there's death benefit, you have a benefit for while you're alive, and cash value growth is just another part of that, another version.
Okay. So these are whole life policies. Are they IULs? They're IULs, right?
These are index universal life policies. Yeah.
Index universal life. And so what's special about that product that makes this work for the living benefits? And you said growth and indexing. Talk to me about those two things, indexing and growth. What does that mean?
Sure. So that means, you buy a term policy. What are you doing? You're putting the least amount down for your health rating for the target death benefit you want.
Yeah.
This will be the reverse. We're going to put the most amount of premium and design it with the least amount of insurance.
Why the heck would anybody put the most amount of premium for the least amount of insurance? That's counterintuitive to the average person, right? They're always trying to get the best deal. Isn't that a bad deal?
If you want coverage. So yeah, exactly right. It depends on your goal, because if your goal is cash value accumulation, you want to minimize that insurance because the cost of insurance is a factor. Not necessarily a deadly factor, but a factor. So it's that reverse, and it depends on that client's goal. So someone that's looking for a large amount of coverage, yeah, that's not the best avenue for them. Absolutely.
You're going to get the people who listen to Dave Ramsey's podcast and all his shows saying, that guy is wrong. That guy is wrong. Buy term and invest the difference. What's the advantage of doing it inside of a life insurance policy that has cash value accumulation and can grow? Because I know we're still dancing around some of these terms, and I want us to get right down to, like, you're talking about, if your goal is coverage, then it would be a mistake to do this. If your goal is pure coverage protection, you would buy the lowest price term for the maximum amount of coverage. But if your goal is cash accumulation, well, everyone's goal should be cash accumulation. I think everyone should want to accumulate cash, or at least grow cash, right? Grow it. Why would you want to do it inside of a life insurance policy?
That is a fantastic question, right? So, if you follow the math, there's great backing behind that long-term play. It's not a short-term play. Someone who's looking for doubling their money in 10 years, I can't help them. If they are looking for a 30-year 25-year, 40-year deadline to build cash value and take distributions, they can do pretty well. Why? Well, as we saw this first and second quarter, the market's going to cyclically have recessionary periods.
Of 2022. Of 2022.
Exactly.
Yeah.
And then 2008, huge one, right? .com bubble in the early 2000s again. It happens every 15 years or so. So I want to be protected in that scenario.
Okay.
And this is a great place to protect and slowly grow forward. And because you have that downside protection of a 0% floor or something about there, right? You can really compound your interest over time. Whereas if you're taking a recessionary period in an investment plan, you're compounding backwards.
So you said if you have a 0% floor, again, some of our listeners don't know what that means. Okay. What's a 0% floor when the market goes upside down and the stock markets and the Dow Jones and the S&P are going south fast, like they did for the first half of this year, 2022, and people were like losing their retirements faster than they could blink. Why is your money protected inside of one of these products?
Fantastic. So there's a very technical answer to that. I'll probably park that for the time being, but basically when the index goes backwards, like a -5% year, -10% year, you won't go below zero. So you'll maintain your principal balance.
So your money doesn't fluctuate with the market?
Not that direction. No.
What, so does that mean the way you answered that means that it does in the other direction?
Correct. When the index increases in value, there's going to be a cap. There's not unlimited, uncapped growth. Some policies have that, and just there are other factors involved. This strategy does not incorporate an uncapped growth, but yes, you can earn positive when the market goes up. And if you can take those singles and doubles and not swing for the fences every year over a long period of time, that discipline can really pay off.
So you're saying inside of one of these policies that a properly structured plan, utilizing a life insurance product that has cash in it or cash accumulation, or I guess cash accumulation can happen in an whole life policy as well as an indexed universal life policy, right? As if there's cash accumulation in there, in one of these indexed universal lives, you're saying it's indexed against what? Your money is indexed against what? What is it indexed against? Or is it's not in the market, right? It's not in the market, but it's indexed against the market.
That's correct.
Right.
It's measured so
you're
index.
Yeah, and you're protected. So if the market tanks below zero, you don't lose any, but you're not making any. While you're not making any, everybody else is losing their shirt, right? And when the market then comes back up, you start picking up points again up to a certain level. I'm sure the insurance companies, they got to make money, so that's why they cap it, right? And they make the growth above the money potentially for that period of time, and they're hedging. All those factors are involved in that. But you, as a consumer who's investing in that product over time, is giving yourself a protection floor so that when the markets tank, you're safe. And when the markets go up, you're picking up gains in a safe environment to pick up gains, and your money's growing year over year. So the coolest thing about this concept that I love the most is this concept that I think a lot of people don't understand. And that's when the stock market tanks, because people have said this to me before. By the way, I'm asking questions like I don't know what I'm talking about, but I've sold many of these policies. Yeah, sold many of these policies. And I have friends of mine that are in these plans and participating, and they're performing very, very well. But one of the concepts that I think most people get duped on is this. Hey, the market, just dropped 15 points, over the last 2 months, or 20 points over the last 2 months. But it rebounded back to 20 points. So we're at a zero. We're at a zero. And while the market might be at a zero, that is a complete misdirection of information for the investor who's got their money in a market that is fluctuating with that. Why is that misleading to say went down 20 points, came back 20 points, so we're at zero, so nothing lost, nothing gained, we're back to square? Are we back to square? We're not really back to square, are we?
Well, you're not. And for
why not?
For someone that wants to go in depth with this, please research sequence of returns. But in a nutshell, right? If I have $100,000 and I go 50% down in 2021 and I get a 50% rebound in 2022, am I at net zero, Roger?
No, you're at 75,000. You're at 75,000.
Yeah. So it was a net 25% loss. So a percent down.
Because you lost 50 grand in the first year. And when it rebounded 50%, you're only picking up 50% on 50, which is 25. And now you're only back up to 75, even though the market is, on the graph. When you look at the graph, it went down and came back up. It's at the zero line, but your money, you've taken a significant hit.
Exactly right. And it works the other way. If we went the gain first and the loss. Yeah. So the percentage and when they happen is very important. And a gain can sometimes not equal that same percentage in loss. So.
Yeah. And now inside of one of these, what do you call them again? MPIs?
Yep.
Maximum premium indexing strategies. It's a marketing strategy, obviously, when you're talking about these plans. It's a strategy for developing this type of retirement. Really, it's a cash accumulation. I don't think we're allowed to call it retirement plans, right? Or investing, because it's not an investment. It's actually leveraging an insurance product to maximize your return safely. Is really what it's doing, right?
Yeah. I never call them investment vehicles, but life insurance can be used as income replacement. So
correct. So inside of one of these, you're not getting that downward. You're not losing money once it goes below zero. Your money's just parked at zero. It doesn't take any losses. That's why it has such power over time, because you never take those big hits when the losses do come.
That's correct. And if you look at a popular index like the S&P 500, you'll notice those dips. The dot-com bubble is the anomaly where there was 3 years of down markets. Mm-hmm. But the vast majority of the time when you have a down market, you'll see 2 or 3 years of rebounds. And so can you commit to that for a 20-year period, over a 15-year period? Yeah. Because if so, you'll be really rewarded for it. You don't have to worry about that 2008 knocking out your savings while you're in your 50s right before retirement.
Are you talking to me? Because I'm in my 50s.
I'm sure you're doing okay, but any other 50-year-olds watching or listening can relate, may be able to relate.
Aidan, man, it's cool to hear you talk about this. Most people at 25 are not talking about, maximizing performance, maximizing returns in an index strategy. So you've learned a lot, man, in the last 2.5 years, and only 2 years full time. So let's find out a little bit about your results now, because we want to let people know that you're doing okay. Because in this business, I think this industry right now is attracting a lot of young people, attracting a lot of millennials, right? And I think our education system is not producing today what it produced 25, 30 years ago. I don't think it's producing the same result. I think people are overpaying for an education that gets them a more generic opportunity when they walk out the door. And with our modern economy and being able to work from anywhere, essentially, and do all kinds of things now that weren't even a possibility 25 years ago, I don't think our education system is caught up with it. And so I think students are coming out of college 4 years, $80,000, $100,000 in debt, a lot of them, saddled with now a government student loan that's not, well, it may be forgivable. Who knows what's going to happen with this administration? And that'll just be passed on to the taxpayers. So all of our taxes will go up and inflation keeps going up. But, you're tied to that student loan or whatever it is for the rest of your life. You got to pay that off. And they get out. And according to a recent New York Post article, only like 62% of people, college graduates, have a job that does not even require a degree. 62%. 62. You're one of those, right? You had a job when you first started that didn't require a degree. And here's the cool thing. Being a life insurance advisor, life insurance agent, Medicare agent, a health advisor, a health agent, doesn't require a degree. We're in a profession that doesn't require a degree, and you don't have to go $80,000 in debt. It's almost like the stock market going down 80. Now you got to figure out how to get it back. Like, you don't have to go upside down. And here you are at 25. Are you in the 6-figure earning range?
I'm fortunate to be there. Yes.
Yes. And just after 2 years of being full time. Do you know how rare that is for people coming out of college and 2 years into a job making 6 figures? That is rare. That is in less than 10% of the people. And yet you achieved it.
Hey,
what would you?
Sorry, go ahead.
No. Go ahead and finish your thought.
I was going to say, the information's out there. I know you made a podcast very recently about how to make 100K first year in the business. And those are steps you got to follow. So I niched down. I used a system that I knew it could work, and I duplicated it.
Mm-hmm. What would you attribute maybe 3 or 4 keys or some of the factors for your success, why other people fail out, but why Aidan Stout is having 6-figure success in the industry and is only growing. It's only getting bigger. What would you attribute some of the factors to? If people are listening right now and they're trying to get the nuggets on what it takes to be a 6-figure earner in this business at age 25, what are some of the things that you would want them to know that they need to be thinking about to put themselves in a place where they can do that?
Sure. And you'll know some of this stuff because you all have heard it before. But one thing, Landon loves to say, people work with those that educate you. So to educate someone else, I had to educate myself. I took some time. Most people don't read. Most people won't read. If you take the time to read every week, 20 pages maybe, doesn't have to be astronomical. But if you're taking some time, a couple hours a week to get better at your craft, you'll start to separate. And so, you could say I was up against it being a young person talking to people 30 to 50 even about retirement planning. They're like, what does this guy know? He's never retired. But the knowledge I led with, it wasn't personal. It was about them, it was about solving their problem. And so it's not about you, is the second piece I'd give you. And third, I'd say don't spread yourself too thin. Really find a good mentor, find a good system, find someone who's doing what you want to be doing, and give it a couple years. Jared and I coming into the business, Jared's my business partner. We went to school together, and he wanted the same opportunity as well. And we said we give it 3 years to see where we're at. Now that I'm here, I'm very excited. So I think putting some time frame behind it, give yourself a chance, will be really important.
Let's talk about a little bit. I want to finish up. We probably got another little bit, but I want to ask you a couple more questions. In the business for the indexing portion of the business, did you work leads? Did you work a lead program of any type?
Yes. So the founder of that is Curtis Ray, has a very strong TikTok following. He's a fantastic marketer. He found a really unique way to communicate his message on social media. He's talking about insurance, but people are flooding to him. He found a way to make it captivating and to speak in a way that was receptive. And so he would generate leads, and I'd meet with those people. And it was a very good lead outlet, and I was able to be successful. And now I want to learn to be my own marketer eventually, as you're currently doing. Very, very successful.
Do you need leads to be successful in that segment of the business? Is it required to have leads, or what other opportunities are there to develop? Because I know some people that are in your space, they don't work any type of leads, and they're constantly seeing people. Sure. What other avenues are there for people to break into that in this specific segment? I know you've diversified this year, and now you've got a lot of other opportunities, to sell multiple lines of insurance. But in that particular segment, are there other ways to break in, or do you have to have leads?
I think leads definitely help because it's a difficult concept to articulate to someone who's not looking at retirement at the moment. So I think looking for a retirement avenue is key because now they're receptive to new information. But warm market has been very successful for us. We've gotten many referrals because if you have quality service, you get referred. So it can be a combination of those three: leads, warm market, and referrals. Then in the future, websites, media, billboards, those things can come, but those are the three things you want to master up front. And I think leads are important, but they don't have to be the full piece of the pie or the full pie.
Yeah. You said something a little bit earlier too. You said Jared and I, made a commitment. My partner, Jared, and I. How important is it for you to have someone good that you're running with in the business? How important is that relationship to you? And would you attribute your success and, the fact that you've become a 6-figure earner now, just in your second full year of the business? How much of that would you attribute to having a running buddy, a partner, someone in the business with you that you're being accountable to, they're being accountable to you? How important would you say that is to success in the industry?
I think it's really important. And having seen Cody's 8% a few times, I see that other very successful people have done the same thing. Mm-hmm. And whether it's a small team, their spouse, or a good business partner, friend kind of thing, like Jared and I are doing, super important because they're with you at the lows, they keep your level head at the highs, and it really helps you build consistency because you're not alone. So the biggest turning point for me was like last spring is when I stumbled upon Landon and Cody's content. And it was great. It was like, oh my gosh, there's a community for this supporting me. And
Like a year and a half ago, you're talking about.
yeah, yeah,
Yeah.
sorry, spring of 2021. And that
Yeah.
led to 8% power players, those things, because he's established a community. And I find great value in that. The other attendees do as well. So yeah, but that in-home support system, those people in your life, super important. You want some very supportive roles, but then there's also a greater community that's going to help you even more. Super important.
You find you have value in networking with people that you can learn from. Let's talk about how you feel about networking and even investments into networking and making sure that you're putting yourself in the right environment. How valuable is that for you to put yourself in some of those rooms? And what have you done? Because I know we've connected at these. This is how we met. So why don't you share about that? Because I think a lot of people listening and a lot of our listeners, they're trying to figure out how to have success. They're trying to do it by investing no money. Yet the system out there, our modern economic system, says you've got to go to school for 13 years, kindergarten and all the way through 12th grade. Then you got to go to school for another 4 years in a post-secondary education. And then if you're really serious, you got to do at least another 2 to get your master's in something, some kind of graduate program. And then you can become qualified to become a 6-figure earner. And yet people are now trying to transition away from something that's not working for them, or they're looking for a way to make more money. They feel like they're stuck in a job or career they don't love. They're not making enough money. They feel unfulfilled. All this uncertainty right now in the economy, what they thought was going to be there is not, and they're looking, and yet they still try to do it with no investment. They try to do it with no investment of time or money. And really, they're trying to hack it on themselves, and they're just listening to videos, watching, listening to audio podcasts or watching videos, trying to hack it. But you took it another step. You said, I'm going to invest in my relationships because I want to access the knowledge in the pool of people. So what have you done, and what would you say that's done for the trajectory of your career? What would you recommend to people thinking about how to proceed and how to get headway traction to become successful?
Yeah, super important to invest in yourself. Early on, I think especially it's important. Like if you're getting a steady profit margin early on, I put that back into you even before your business, because you are the business, right? Potentially, if you go independent. So yeah, 8% and working with Cody and meeting you, those were great opportunities. And there was doubts. I'm going into a group with a bunch of, some are millionaires, many are. And it's like, well, what value could I bring those guys? But you show up anyway and you figure it out. But what I'd written is I want to have the lowest income in the room. And then 5 minutes later, he made his presentation. It was like, well, there you go. Are you going to do it or not? Because if I hadn't done it, I would have broke a lot of self-trust. So I got up there and met people like yourself, and it's been so important to network. So I do local networking groups. It's really important to me to become a focal point in my community long-term, seriously.
Yeah.
And then the greater, finding communities like what we're doing, Life Insurance Academy, 8%, where you can relate with other people that are in the same boat and support you. Networking is huge. I would start with yourself, then invest in your business and networking, and watch those relationships build. But be serious about those relationships, right? So that it's genuine and it can lead to a really healthy place.
Well, as a result of your investment into a mastermind group, we spent time in Naples on a beach. We just talked literally on a beach in Naples.
Yeah.
We just connected and talked because we were both there. And it wasn't even a scheduled event. That's the cool thing about those events. And then in Puerto Rico this past spring, we got to hang out again.
Super fun.
We got to know each other. Now you're on the podcast, right? So I really respect the fact that you're leaning in, that you're making strides, that you're not afraid to take risks on you. When some people are most of their life, they're told you fit in this box, do this next, do this next, do this next. When it's not working for so many people out there, you are like, I'm going to bet on me. I'm going to bet on me. So, Aidan, I'm going to give you an opportunity to let people know, number one, why they need to get in this business, and number two, why they need to connect with you and Jared.
Absolutely. hey, connect with us on how we can help. But absolutely, if you'd love to learn more about what I'm talking about, I'm sure I can learn from you. We have a YouTube channel called Your Compound Coach. It's new. We're putting stuff out there, but it's a great
I
place
love it.
to see more of our content.
Uh-huh.
You can reach out to me on LinkedIn, Aidan Stout. Happy to connect there. Um, I'm sorry, what was the first part of the question, Roger?
First part of the question is, why should people get in this business?
Oh, that's right. Yes.
And then why should they connect with you?
Yeah. So, insurance is a great vehicle. I would take a look at those long-term goals. It probably involves having time and money as, in plentiful quantity. So this is a great vehicle to get that started, and you may just find out that you love it. So I think being a business owner in your 20s is a great lesson because you have skin in the game, right? You learn responsibility, you learn accountability. You don't show up, nothing happens. Those
Correct.
things are super vital and help you separate from an employee mindset. And if you want to be getting your time and money back, it's going to be business ownership, whether it's small business or largely scaled. So I think there's a lot of valuable lessons in there, and it'll help your self-development, whether you like it or not.
Cool. And you can make 6 figures.
Or 7 or 8 or 9.
Or 7 or 8 or 9. There you go, man. Well, cool. Aidan, it's so cool having you on this episode today. Excited, man, about your trajectory. We're going to be watching for you and Jared to blow it up and continue to light things up. And if you want to get connected to him, he gave you all the places where you can find him. Let's make sure we put a link up there for is it the Compound Coach?
Yeah, Your Compound Coach.
Your Compound Coach. We're going to get a link up. We're going to do something. We're going to put up a screenshot of your YouTube channel or something so that people can find that. And we'll put a link also in the description in the show notes. You can find that out. And if they want to find out more about indexing, are there some books you'd recommend before we end? Is there a book you'd recommend that here's a great book to read? It's a good starting point. After you read that book, call Aidan. What's that book?
So I'll give a book and a website. Great book to start with is Everyone Ends Up Poor. Curtis wrote that. If you want a more in-depth version, The Lost Science of Compound Interest is great. But hey, if you want to just watch this in a video series over 20, 30 minutes instead of a book, compoundinterest.com. It's a great place to start.
Or go to your YouTube channel, Your Compound Coach.
Yeah.
Cool. All right. Thanks, Aidan. Thank you so much for being on today. And thank you guys for joining us for another episode of the Life Insurance Academy podcast. You can connect with us on all the socials, of course, and you can find us. And I'd stick around and get on one of the next videos, probably right here somewhere. But we'll see you on the next episode of the Life Insurance Academy podcast. Thank you.